Hello and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome all of you here today on this Monday. My gosh, did the market know last week that I was out of town? No, I was out of town. It doesn't necessarily mean that I wasn't watching the markets because I did. I might as well just have been back at the office, but hey, that's the way it goes. So just real quick, so I want you to know that I haven't just taken a week off and don't know what's going on. Watch the market throughout the week. So very aware of it. And I want to talk about that here today. So first off, we also have Connie Hill with us in the chat. We welcome her. I also want to give you a heads up that I have seen this type of price behavior before, and it's different reasons of price going down and volatility going up, but I've seen it before. Okay. Now, every time when the market pulls back, we're always thinking that this is the worst thing we've ever seen. But then when you relate it to other times, price going down, volatility going up, different reasons. We'll talk about that here today. Now, I've also read your comments on X, and I want to get to those. And I've created the content here that we're going to talk about here today in regards to things that you feel like you need help with, etc. So I want to dive right in. Now, remember, with what we talk about here today, it's done for informational purposes only. Should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Options carry a high level of risk, not suitable for all investors. We'll get to that. Also, remember when we talk about examples, they are just that. We will use the paper money software application for educational purposes. Remember that investing involves risk, including loss of principals. Now, investing could be in stocks. It could be in other asset classes as well. I want to talk about asset classes here today as well. And what I want to do is, when I first got started in the stock market, it was 1995, 96. And then, for example, in 1999, 2000, the market fell drastically. And I remember thinking the end of the world was nigh at hand. Okay, a little fun with you there. So, and it wasn't. Okay. And so what I want to talk about is kind of some questions that you've had regarding bear market game plan. Want to kind of talk about some things that the investor needs to know and why they need to know it. Okay. Now, some of the things we talk about here today, you might say, I'm not going to consider all those things, but at least you come to that conclusion. Okay. And I want to kind of share what are some of these 7 points that we need to be prepared for. Okay. Now, first off, I want to take just a quick look at where the market is. And I'm going to show you the paper money portfolio in just a moment. I want to go to the SPX for just a second. Well, let's go VIX. Okay. So one of the charts that we look at quite a bit is the VIX chart. Okay. And we always kind of talk about the moving averages we have on the chart is the 10, 20 period moving average, the whole moving average. And what you're now going to notice is, we had this period where the VIX was falling down. And when that happens, you tend to see some bullish price behavior. And then you actually go back to the crossover that we had. There's the 28th. Now, the 28th was the Friday before I left. Okay. The 31st being last Monday there. And you're going to see that on Monday, the volatility started wreaking its ugly head. Now, you've had a week to see this. Okay. What lessons have you learned? Or have you learned a lesson of maybe how to respect the VIX? Okay. When the VIX goes up, if you're a bullish stock investor or bullish investor in general, you tend to see, prices under pressure. You tend to see support levels struggling to hold, prices up, and then they fade and so on and many other things. And then what you're going to notice is we get into Tuesday, okay, we get to Wednesday, we get to Thursday, which was a big pop. And then Friday, you thought it can't go any higher than that. And it just does the Eiffel Tower right back to the upside. And then today, last night, you're going to see that, VIX went to 60. Now, the highest I've ever seen the VIX is 89, okay? And I literally remember where I was standing in my house. I looked at my phone. I was like, this is unbelievable. Okay, this is awesome. Okay, now here's the deal. It can be, now, the reason why I call the VIX a blood pressure gauge is when the VIX is going up like this, there's a lot of fear, anxiety, and panic. I want to talk about that, okay? And I want to kind of talk about some things you might consider. So first takeaway here is we need to respect the VIX, right? When the VIX goes up and crosses over and has that green shading, the investor needs to start to consider, or maybe could, start to consider some things. And I want to kind of bring this up now as we talk about this. So first couple things that I want to kind of bring up is when we talk about kind of, and I'm going to label this really as a bear market, okay, game plan. Now, do not take bear market as, oh my gosh, there's going to be no bullish positions. That's not what I'm saying. But what I am saying is what I said the previous week, which is there's probably going to be some stocks or companies that are going to struggle, okay? And I think we've seen that, okay? There will be some stocks, though, that might not struggle as much and might be bullish and have a positive trend. But there's probably going to be more stocks that probably go down than up over time. Now, we could be wrong, but let's kind of use that as our starting point. Now, the biggest actually thing is when we talk about kind of lessons here is, can you see, and the key word is execute, okay, stock potential exit signals. Now, what I'm talking about here is the two moving averages, okay? So if I went back to this chart and I said, hey, I'm going to use example given, I'll go ahead and use example like, I don't know, Microsoft, whatever. And if I looked at Microsoft and said, hey, what are those two exit rules? This is the starting point, okay? If the investor doesn't do this, then the other things probably don't do very well either. This is the starting point, especially for stock investors. Now, by the way, if you say, James, I'll buy a group of stocks too, that's fine. I'm still talking to you, okay? So if all of a sudden we're kind of going up, 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 and all of a sudden what we've talked about is the moving averages go red, there, okay? And it goes there. And if that crosses over to the downside, you've kind of had really some negative signs that there is price pressure, okay? Now, why it did that doesn't matter, okay? There's more sellers than buyers. The end. Now, if the investor says, well, James, on that date when I had the moving averages like that, two red lines, crossover, etc., I got out, the investor exits that if that's their criteria. And what you're now going to notice is it felt bad initially, but then the sell-off ensued further, okay? So the first thing that I want to kind of make sure we're clear on is, can you see, can you, not me, can you see, and the key word is execute, stock potential exit signals, okay? This is massive. Now, James, why do you say it like this? Well, because I know a guy, his first name James, last name Boyd, that would see sell signals, and then I would say, well, maybe I just like this company, okay? Maybe I just want to hold on to this one, okay? If you're going to be a technician, be a technician, okay? The moral of the story is if you have sell signals per your rule set, you might consider exiting. This is here for your stock investor. So this, I'm going to say a stock investor, okay, not using options. This is massive, okay? Because the other things we talk about after this, it doesn't matter if you're a stock investor, okay? Now, the second thing I really want to bring up here is, do you consider covered calls? Now remember, covered calls is an income strategy, okay? The covered calls is the first step in learning how to reduce delta. This is massive. But the biggest thing, the con about the covered calls is it's not a protection strategy, okay? But it is something at least where you could say, I'm going to sell a call, think that the price is going to drop or stay flat, etc. Going to try to create credit and lower the potential break even, okay? That's the idea. Now, the third thing is kind of what we've talked about historically, which is, do you consider, okay, protective puts, okay, on your stocks? Now, then we've talked about this quite a bit. Now, language such as married puts, what does that even mean? Long stock, okay, plus protective put, okay, I'll say it like this, plus a long put. At the same time, okay? Now, do you have to do it at the same time? No. You could actually, I label this as kind of more of a protective put, bought stock first, then later bought put. Okay. Now, did you probably have some situations last week where you said, James, I was in one of those, two of those situations. Maybe this was you last week where you said, James, I have some stocks. I'm starting to become a little concerned And maybe, for example, did the investor say, I later then bought the put? Now, how hard is that? Okay. We could go into the trade tab. We could review kind of how liquid those options are. And could the investor click on the ask price of the option they want to buy? Number 3 is massive because at this point, we're defining the risk. That's huge. Okay. Now, the long put, we're paying for it. Okay. And it's not risk indefinitely. It's defined risk until expiration. Are there any questions about this? Okay. Any questions? Any questions? Now, by the way, I'm going to ask you, so if someone said to me, James, like, when does the investor maybe consider the covered calls in trend 4 and 5? When does the investor consider the protected puts in trend 4 and trend 5? If the investor is waiting until trend 1 to occur, that just means that they're now considering buying puts or selling calls after the drop, or the drop is materially already happened. Okay. Now, number 4, what do you think number 4 is going to be? What do you think it is? Well, we already talked about covered call. We already talked about a protected put. We're just going to talk about collar, okay, strategy. And what is that collar strategy? Well, the collar strategy is going to be the long stock, okay, plus short call, plus long put. So what you're now going to notice is this really number 2 and number 3, they really kind of come into number 4. So someone might say, well, number 4 is so different than 2 and 3. And I would push back on that and say a collar strategy is a covered call. Just has a downside put too. And we would say a collar strategy is a protected put because you have a right to sell and it's defined risk. Okay. Now, the deltas on 2, 3, and 4 are different initially. Okay. But the biggest thing is if someone said, James, of these 3 covered calls, do I want to be weak on that? Well, remember, that's a starting point. Got to learn how to consider to collect a credit. Second thing is, how do I define the risk? And if I could actually get the credit to pay for the put, could I maybe consider the collar strategy? Now, here's the sad part. Sometimes investors have to get to a pain point to where they say, okay, mercy. I'm now willing to take a lesson. I'm not really sure if we want to do that, okay? I mean, the more of the story is we want to kind of have a game plan in place before things happen so we don't have to say mercy all the time. We're not in Paris, okay? Merci. Okay, now, here's the thing. So the comment from Robin is, in events like this, do we go from trend 3 to 1 directly? Well, what would cause it to go from 3 to 1? Prices crashing down. Prices crashing down. Could that happen? Sure. The more the VIX spikes, the harder the crash typically on stock prices. Okay? So could that happen? Sure. Now, when we talk about buying puts, okay, does anybody kind of remember the criteria that we talk about? We talk about buying those puts. Like what length of time? When we talk about the length of time, what length of time are we talking about? Length of time. We're talking about 20 to 50 days to expiration. Okay, 20, 50 days to expiration, DT. And we're talking about selecting or considering the 30 to 40 delta. Okay, so that's kind of like, that's where we're going to look. But the math, okay, beyond that is, we're going to look at, for example, the option price. Okay, this is where kind of the question is in terms of the cost. The option price or premium, okay, I'll just use the option premium. Don't worry, we're going to do examples of this. Option premium divided by stock cost basis. Now, someone's going to ask this question. I wonder if I bought Walmart at $3, I've been holding on to it for 4 years. Did you really do that? No, I was just wondering. Okay, so good. So when we talk about the stock cost basis, it tends to be a stock cost basis is recent. So when we talk about the option premium, if we said the option premium is $2 and we said the stock cost basis was, let's say, 100, the investor that has done this over and over and over and over again, they might say, James, 2% is the max. Now let me just make sure you're following along. Now, by the way, could you buy puts for a bigger premium? Could you buy it for a bigger percent? You sure could. But we just know that the more you pay for the put, the more the stock has to go up just to break even. Now, I had some person tell me that I don't really even look at what you pay for the puts. I told the person, I don't think you've ever done the strategy, okay? You look at what that put is, the cost of it, the premium relative to the stock price, because that's going to kind of affect the break even, okay? So if we said, hey, we bought a put for $2 and we paid $100 for the stock, then what would be the break even? Well, at expiration, well, it'd be 102. So if someone says, I never look at the put premium, then they're like, they don't even know what the break even is at expiration. Okay, don't you want to know where the break even is? If you could potentially make money, okay? Or at least be above water, that's the point, okay? Now, let's say the puts are expensive. Follow me. If the puts are expensive, what does it tend to lead us to? Well, wait, if the puts are expensive, then what does that probably mean? Well, if the puts are expensive, that means the calls are probably filthy, okay? Those calls are probably juicy. Why? Because the implied volatility is pumped up like a balloon, a hot air balloon. So on the puts, if the investor buys the puts, you got to pay for those higher price puts. But you got to remember on the calls, if you sell the calls, there's high implied volatility, big premiums. And this is why the caller strategy is so blasted important. Because when things drop down, a lot of people then will look at buying the puts. One thing I want to make sure that we understand, and I know we were on that little 1 minute break, is I need you to understand something so we're all on the same page, okay? When you invest in the markets, you are effectively choosing a strategy whether you understand it or not, okay? And let's just make sure we're all on the same page, okay? So let's say kind of we looked at this, let's kind of say that on this left-hand side, volatility, okay? Let's talk sectors first, then we're going to talk about allocation, okay? Now, let me tell you something. I have hurt myself a lot more than the stock market ever did, okay? You could be extremely bright and do dumb things, and I have. I'm just telling you that myself, okay? But the thing is, I learn from those, okay? So I'm going to label this on the bottom as the expected return. Doesn't mean it actually happens. It just means expected. Now, the one thing to kind of consider is this is very important, okay? When the VIX rises, what sectors tend to maybe go down on a higher percentage? Anyone tell me what that is? Well, you probably say that, James, the technology, I'll label as K, technology. I'm going to label Y for discretionaries. I'm also going to include energy for E for energy, and I'll put B for basic materials. I'll put BM, basic materials. So if you're starting to see maybe where the market is deteriorating, and you have stocks in technology, discretionaries, energy, and basic materials, those might be the stocks that you say, you know what, James, I'm going to start to trim some of those, because usually on a higher percentage basis, like percent-wise, they tend to drop more. Now, when we go to the other side, maybe something like utilities, U, V for healthcare, I'm going to label R for staples and RE for real estate, okay? Now, as we saw last week, it's not that those areas don't go down, they just don't tend to go down in the same percentage. And this is why it's kind of nice to have some diversification, okay? And also the middle is, well, what about financials? I'm going to put financials right there. M for financials. I'm going to also put I for industrials, which would include transportation. Now, if you ask most people and said, well, James, last week it was just brutal. Well, the people that probably really got maybe hammered, okay, or at least it was more severe, they were further out, way out in the stratosphere, probably in technology, discretionaries, energy, and materials. What's my point? If you actually see the volatility go up, the investor might be very aware of, for example, seeing potential sell signals on stocks. If they have short puts in that area, they're probably saying, look, I probably want to consider buying some of these back, because if this goes down, technology, discretionaries, energy, and base materials, they tend to get hit the hardest as far as a percentage basis. Okay? Now, that's not to say that if you have financials or industrials, or if you had utilities, healthcare, staples, and real estate, that they didn't go down at all, but they just went down in probably a pretty good different percentage. Okay? Now, the last thing I want to point out before we look at trade examples and then talk about bearish strategies, but the thing is, we got to first understand these first. First, it's about protecting what you have. And second is kind of considering using the cover calls, protected puts, or the collar strategy. Now, the other thing, last thing I'm going to say on this is allocation. Now, you've all heard of this before, okay? If we kind of put the volatility back on the left-hand side, we put the expected return on the bottom, and we said the investor is 100% stocks. 100% stocks. And why did you put that investor, he or she, all the way out there? Well, because if they're 100% stocks and the market goes down, they have a great sensitivity to what happens in the market. The stocks are correlated to the market. If someone said, James, I kind of have 50% stocks, okay, and this goes back to the question that was asked, I got 50% stocks, but I also got 50% towards maybe cash and or fixed income, where I'm actually trying to make a return on the money. If I took this to the way extreme, James, I got 25% stocks, and I'm maybe 75% in cash and or fixed income, whatever, okay? Something where you're trying to get a return on the capital. Well, not everyone has the same, when the market drops, they have the same experience. It's kind of based on allocation. What I'm going to try to caution the investor is if they said, James, I'm 100% in stocks, which I'm saying stocks and options, and I'm actually levered all the way up into tech, discretionaries, energy, and materials, that investor, which by the way has been me historically, those are the people that really, the pullback just feels like brutal, okay? This is a good learning moment to say, maybe do I want my allocation the way that it is? Second, maybe I'm going to stop saying things like those sectors like utilities, staples, real estate, and tech, staples, healthcare, etc. They're boring. Maybe stop saying stuff like that, which happens all the time. Okay, I said that too. I stopped saying that. So I think this is a major moment when markets pull back. How did you learn? What did you learn? And what are you going to actually do to get better? Now, I want to kind of talk about these last 3 points, and then we're going to spend the rest of the time on strategy, okay? When we talk about, I'm going to say 5 here, and I'm going to kind of put a hedge. When I say a hedge, this could be maybe a hedge on the S&P 500. I'm going to also include maybe, let's say, the Russell 2000. Now, you know how we kind of joke a little bit about the Russell 2000. If someone said, James, I think the market's going to go down, they just might, for example, do a hedge. Now, what would maybe go first? Does the investor hedge by putting on a bearish position on the S&P and the Russell 2000? Example given. You could use others. I'm just writing 2 down. Does the investor hedge first? The investor is probably focusing on what they have first. Okay? First. Why? Because those are the stocks you have. And that's what matters the most, because that's what the investor has. What happens with the S&P 500 or the Russell doesn't necessarily mean that's what their stock portfolio does. That's why we're focusing on this first. Okay? And James, do you have experience in that? That's why I just said that. Okay? Now, I want to kind of talk about the bearish strategies. Let's say if we went to war, okay, and we said, look, we can only do 3 bearish strategies. What might be those bearish strategies? Well, we would include a short call vertical, okay, which we're, again, talking about a credit here, okay, talking about a credit. It's an income-based trade. It's a probability-based trade. If someone says, I don't even know what a short vertical is, welcome to your opportunity, okay? Now, that's if you consider options, okay? Second one, if the investor said, James, I need to actually have, and I need to polish up on the long put vertical, okay? The long put vertical is a debit, which just means you pay for it. It's a profitability-based trade. It's not as probable typically as the short call vertical, but you're really trying to actually get a higher potential profit. Both of these are defined risk, and that is a massive point, okay? Massive. Defined risk, Okay. And the last one, does anybody know which one we would actually probably include here that I have not said yet? But if we combine these, we're pretty much going to come to it. And the answer is what we talked about 2 weeks ago is a short synthetic. Okay. And that short synthetic is just using a short call, which is number 5, short call vertical, and then it's adding the long put. Oh my gosh. So there's overlap here. You might say 7 things, I can't remember them. Don't worry. There's a little overlap here. Now, this is also defined risk. Okay. Now, if we are in a bear market, and I'm going to be just brutally honest here, okay? If I said, what do we have in the market that's not great? Well, we're talking about things in the market that, I mean, if we're just a bullish investor and we say, geez, we don't really like what we see. When we look at the last couple of weeks, let's say on the S&P 500, we've had this red shade, right? So there's been some stocks, clearly, that have actually gone down. If I actually flip this, let's say, to a monthly chart, and I said, look, let's say we're intermediate to longer term investors. And we looked at, for example, let's say the month chart, and we said, well, why are we talking about maybe a bear market game plan? Or what are some strategies, et cetera? What are some indicators we need to at least understand? Well, that's not a great chart either, because that goes exactly back to the first thing that we discussed. What is that? Well, number one is when we see the moving average cross down, we would say that is a strike 1. The moving average going green, from green to red, strike 2. And you see that other moving average also red as well. So if someone said, I tend to be more bullish, fine. But there's also going to be some bearish opportunities as well. This is why the investor maybe wants to consider sharpening the saw, okay? Now, this does not mean necessarily the market is never going to be bullish again. It's just going to mean that sometimes stocks go down, okay? Now, if we take a look at this, okay, any comments here? Now, what I'm going to do is I'm going to kind of talk about strategies, okay? And I want to kind of bring up, now I'm going to start with kind of maybe some of you are thinking, James, I'm only a long investor only, okay? And I like to use volatility to try to get in. How does volatility kind of create some opportunities, okay? Now, remember my diagram? We talked about sectors, okay? And when we think about, let's say, Verizon, you could say it's technology, but you could also say it's a staple and so on, right? You can even say it's a utility. Some stocks might be in, let's say, a couple different industry groups. Well, one thing that happens when the VIX goes up, the volatility on many stocks also goes up, okay? Now, what I'm going to do is I'm going to go to the trade tab. Now, tell me how often you see Verizon, if we look at the options with 4 days remaining to expiration, that has a 60 on the implied volatility. The answer is not very often. Even if we went out to something like 40 days, which is where we like to look at to kind of see where that volatility is, how often do you see Verizon have a 37 implied volatility? Not very often. So what's the point? Well, let's say the investor says, James, I'm a bullish investor. I don't do bear stuff, okay? I'm going to do a little assortment here, okay? Try to make everyone kind of like feel like they got something from today's discussion. So number one is if the investor said, I want to maybe, let's say, and I want to do this. Now, number one, one of the lessons we learned from last week is maybe it's not a good idea to have all your strategies or all your positions in one expiration month. Because if we had all the eggs in the April monthly expiration basket, that basket would have been smashed so far. So what we're going to do is we're going to try to go a little bit farther out, okay? Now, if we go a little bit farther out, we're just trying to say, could we try to get a little bit more time? Now, this is also very important to watch and not just gloss over. We know when we have higher volatility, sometimes the spreads on the options widen out. Be careful, okay? Do not assume that it's liquid like always. You get some crazy market conditions, high volatility, wider bid-ask spreads. Maybe hard to get a fill. Now, what we're going to do is we're going to sell the 40 strike here. Now, I want to go back to the paper money, okay? And if we go back to the paper money, I want to go back to the trade tab. I want to do VZ. I want to go to that June expiration, and I want to look at this. Now, before we go there, as the market fell, what you're now going to notice is we have some more cash. As positions get stopped out, okay, there's a return of capital. And what we're going to try to do is do a little mixture of bullish and bearish trades. What we're going to do in this case is we're going to try to sell that 40. Now, I'm thinking about to myself, like, how many could we do given that no one position would be, let's say, over maybe 5, 8, 10% of the portfolio value. At the most, we're going to go ahead and actually sell 2. Now, if you take a look at this, you're now going to see that we're going to sell 2 of these, the 40, and we're going to actually try to push that to the mid price. Now, I want to kind of be 100% clear. What's the risk of this trade? Well, the risk of this trade, if we sell the put only, we're now exposed to the volatility rising, okay? So if that volatility even went higher and higher and higher after we sell the put, it could inflate the puts up higher and higher, and we would be underwater or have an unrealized loss. Noted, okay? After you saw that last week. Now, what I'm going to do is I'm going to confirm and send this. Now, the investor might say, well, James, I don't like this because I want to have a downside protection. Can we just change that for just a sec? We're going to right-click on that, sell, going to go to vertical. Now, what I'm going to do is I'm just going to buy a put far out of the money. Don't ever think it's going to be worth something. But if you said, I'm doing this in an IRA, which many people might consider, I just want to have a downside like threshold, downside risk management. Fine. We're going to buy the 25s. That has a lower delta than we normally look at, but the bid-ask spread on that's pretty wide. We could go the 30s as well, but I'm even going to go lower, okay? If you go lower, it just makes the credit a little bit higher. Noted, sell 2, confirm send, and there it is. So wait, if you're a bullish investor, a lot of bullish investors will say, look, I want some companies that are probably going to be in a better position to handle the fluctuation. They're probably going to be around on the opposite side of this, okay? Now, how many phone calls did you not make because of this, okay? I think there's a lot of times where you might say, James, I use my phone just as much. Now, I want to also go back to one other example. Let's say the investor said, James, I want to look for maybe a tech stock. Now, what's the risk of a tech stock? Well, if we just see in the last couple of days, that stock, if we look at kind of where this was on, what, Thursday? Down to where that low was, it went down 14% in 4 trading days, 3 trading days. So the moral of the story is anything is possible. So sometimes the investors like to go to the tech stocks. Why? After the volatility spike, well, because the volatility is higher. Why are we going out to, let's say, June's? Why are we going out to, let's say, May with 39 days, etc.? We're going to try to give these trades a little bit more time for them to work. Now, for our previous comment before, notice when you have a higher VIX level, look at the bid-ask spread, 90 cents wide. Look at that one, 40 cents wide. Do not assume that they're tight bid-ask spreads. The higher the VIX, wider the bid-ask spreads. People say, well, you could have just bought puts. Well, when you make that statement, you could have just bought puts. You don't know if that was actually a trade that you would actually do based upon the tightness of the bid-ask spread. Now, if I said, hey, which one kind of has the, or had the tighter bid-ask spread as it moves, as I finally kind of look at this, let's say the investor says, I'm going to try to sell the 215. Now, if we're talking about doing a bullish trade, and the investor says, James, I want to kind of take this back and maybe try to sell the 215 and then buy the 205. Now, you also have to understand that in a volatile market, it might be harder to get a fill. Prices are sloshing around, okay? Now, when we look at this trade and say, okay, so what do we got here? Well, you got a 317 potential max profit, 683 potential max loss. And then when we look at those numbers, 317, okay, bring out the calculator here. What's the ROR there? Well, the ROR, if I did that, 317 divided by 683, it's 46%. Now, are we not saying that IBM might go down further? It might. But why do some bullish investors come in? Well, they come in because they say, well, we're getting some abnormally high implied volatility. Even if we just got a snapback to where it broke down from, the investor might be able to capture, okay, the fluctuation. Now, the comment from Probability Trader is don't pay attention to the intraday VIX. Or that was a comment. Yeah, I would agree with that. It's not that I don't look at it, okay, and you're making a comment. I'm seeing that comment. Just kind of watching where the level is, okay? So we're going to sell the 215, buy the 205. This is a short put spread. Now, this is also a major point that in a more volatile market or a bear market, the investor might say, I'm not going to put out the capital to buy the shares because buying the shares is risky. Why is that? It's a higher delta, okay? It's a bit, you're putting out a greater amount of capital, okay? Remember, when we talk about delta, we're talking about the change in the option price over the change in the stock price, okay? How much the option approximately moves given a $1 change in the stock price up or down. Is that guaranteed? No, just a model, okay? Now, if we go ahead and say confirm and send, let's see if we can get filled, and note that commission right there, send the order. Now, what I'm going to do is I'm going to go back to something. Let's go back to the VIX for just a second. So first trade we actually did was on VZ. We're kind of looking for business models that are probably going to be around, less affected, not affected, okay? It's correlated to the market, but we're also going to look at an example of a tech stock that also might kind of be down near the area of support. Now, when we look at, let's say, where the VIX was, VIX overnight went to, or this morning, went to 60, okay? It's amazing, just amazing. We're at 46. Now, here's the thing. We have had an onslaught of negative news. Do we never get any positive news? Nothing. Okay, not even just okay. I think sometimes you got to remember is when the markets fall down, things on a price multiple basis, longer term support level, right? You can get short-term traders covering shorts, intermediates looking to go long, long-term traders looking to go long, etc. And you get probability-based trades that might be better set up for shorter-term bullish positions. Okay? Now, the one thing that we want to respect is what I want to go into next. One of the risks that we actually have in the current market is we see a lot of stocks where they've fallen down, okay, where they've fallen down, okay, and they rally back up. Do you notice where we rally back up to? We rally back up to the 10-period moving average. Remember what we said before, right? If we, for example, have stocks below the 10-day moving average, the path of least resistance is down, and the prediction, pain. I've said that 100 times, okay? If the price is below the 10-period moving average, with the prediction, pain, okay? And sometimes that pain is even more severe than we even thought, okay? Now, I want you to watch out for a number of these stocks that have fallen down, and notice we kind of see some behavior where they maybe come up to a moving average and they drop back down. They come back up to a moving average, and then people use the moving average as a resistance and then sell it back down again. And they look to put on bearish positions at the downward sloping moving average. This is the exact opposite of what a bullish trader does with rising moving averages. And instead of them buying off support, they're really selling at the moving average and or resistance and putting on bearish trades. So keep an eye on this. And we're seeing this like throughout the day. Oracle did it as well. Price fell down, rallied right up to the moving average, And for some people, they try to put on those bearish trades right at the moving averages. Okay. So I want you to kind of keep an eye on that. Now, the one thing I do want to make mention is when we look at, let's say, a bearish trade, and I just want to speak to one trade just real quick. I don't really want to get into it. We'll get into it more. But James, when we talk about, let's say, a bearish trade, like we talked about a short synthetic, what does that really look like? Okay. Well, a short synthetic is the credit side of the trade. Okay. The short, I should say, with a short synthetic, you have a short call vertical in upfront credit. Good thing about that is a credit. Bad thing about that is it's a cap gain. The long put, that is the side of the trade that if the stock really falls, then it could get ugly. Okay. Now, that's the side of the trade. If the stock falls, which it did, that's the side of the trade that really came out quite well. Okay. Now, what we've learned is if the investor just maybe applies a hedge, okay, second, maybe does 2 or 3 bearish positions and then practices the sell rule set on their stocks and so on, that can help. Okay. The investor doesn't have to do it maybe all. They could still be having drawdowns like this portfolio did. But the biggest thing is just kind of doing some of those things could be potentially helpful to consider. Now, what I want to do is I also want to go back at when we talk about, for example, one other trade. I want to look at it just real quick, a bearish trade for just a second. And I'm going to bring this up. So let's say you said, James, I want to get in the market, but I'm nervous. Okay. And I'm a stock investor. Okay, fine. Okay. But I'm nervous to get in. And the investor says, I want to buy one of my favorite dividend paying stocks. And it could be, I'm not so infatuated with the stock. We're just talking about the strategy. How does the investor maybe tip their toe back in the water without feeling like they're going to just smash the potential portfolio? Well, we know that the investor could apply the collar strategy. The collar strategy is not just a protection strategy. It's also a directional strategy. Now, if I went in here and just said step number 1, buy the shares of the stock. The investor buys the shares of the stock, well, clearly they're bullish. Else why would they buy the shares of the stock? Second, we're going to go down to a single order. First trigger is SEQ. Now, if we did this, the investor is probably more concerned about the downside. Well, if we're more concerned about the downside, we want to define the risk. Now, a lot of times when people see stocks fall down, they'll say comments like, well, the puts are too expensive. Well, maybe consider the collar. Because if the puts are too expensive, that means the calls are probably rich. Now, what we're going to do is we're going to come over here to, let's say, this case, which is we're going to buy, let's say, in this case, the 145. And we're going to try to buy that for 510. Now, that's the downside. We have a right to sell the shares at 145, a defined risk. Now, this does not cap the upside. That's a married put. Buying the stock, buying the stock, and buying the put at the same time. Unlimited potential. But the investor said, geez, I don't really want to actually push up my break even that much. Could I sell something as well and try to get some upside potential? You could. And what you're now going to see is we're going to sell the 155. Now, if we brought this up on the risk profile, so I got to close here, you're now going to notice that this is your collar strategy. Max loss, max gain. And now what you're going to see is we're going to take this trade and it has a defined risk to it. So if I look at this trade, now what I'm going to do is notice the commission to sell the call and buy the put. I want you to practice some of these short put verticals. I like you to all practice also a collar. This is buying the stock and putting on the collars at the same time. That's what I want you to do for homework. This week, we'll talk more about having a plan for the short call vertical and long put vertical and the short synthetic as we kind of polish, if you will, a bear market game plan if it were to continue. Now, I'm out of my time here today. I want to thank Connie Hill for answering those questions in chat. The also thing to kind of remember here as I send that order, when we talked about examples, they were just that. Stay tuned for Cameron May coming up next at the top of the hour. And this has been the class on trading with technical indicators, focusing on a bear market game plan, having some strategies in place. And we're going to focus on these for the next 2 weeks in making sure that the investors are prepared for price action that might even go down. With that said, stay tuned for Cameron coming up next. Bye-bye.